In its second quarter report, GE Vernova delivered organic order growth of 88%, a $176 billion backlog, and higher revenue and free cash flow guidance. The stock still sold off. That does not mean the demand story is broken. It means investors are asking a harder question. How much of this backlog will convert into durable, high-margin cash flow? My provisional answer is that the quarter strengthened the business thesis, but it did not make the stock an automatic buy. The decision now depends on three filters: profit mix, backlog quality, and capacity execution. Start with the apparent contradiction. Revenue rose 22% to $11.1 billion. Adjusted EBITDA reached about $1.2 billion, and free cash flow reached $5.1 billion. But earnings per share missed the consensus estimate. Adjusted EBITDA came in slightly below expectations, and full-year EBITDA margin guidance stayed at 12 to 14%. That is the first answer for anyone searching GE Vernova stock after earnings. The market was not rejecting the power demand story. It was rejecting the idea that every strong headline should produce another immediate expectations upgrade. And the segment breakdown explains why. If the entire company were improving at the same rate, strong orders should have produced a cleaner profit beat. They did not. Power orders rose 135%, supported by gas turbines and services. Electrification revenue rose 68% as utilities bought more grid equipment. Those are not speculative projections, they are reported operating results. But wind moved in the opposite direction. Wind orders fell about 40%, while the segment's EBITDA loss widened to $275 million. So, the quarter contained two different businesses. Power and electrification are benefiting from a shortage of generation and grid capacity. Wind is still absorbing project costs and weak onshore demand. That changes the interpretation. Before the segment breakdown, the sell-off can look irrational. After the breakdown, it looks more like an expectations reset. The strongest businesses are accelerating, but the weakest business still limits consolidated profit quality. For a long-term investor, the first monitoring point is therefore not total revenue growth. It is whether power and electrification margin gains continue to outrun the drag from wind. Now, consider the $176 billion backlog. GE Vernova defines that backlog as remaining performance obligations. It increased by $13 billion during the quarter, driven by equipment and services. That is meaningful. It gives the company unusually long demand visibility. But a second number requires more care. GE Vernova said its gas equipment backlog and slot reservation agreements increased from 100 to 116 gigawatts. Management now expects at least 125 gigawatts under contract by year-end. The important phrase is backlog and slot reservation agreements. A capacity reservation is valuable because customers are competing for scarce production slots. But that combined gigawatt figure should not be treated as revenue already recognized or as cash already earned. The economic chain still has several steps. A customer reserves capacity. The project advances. Equipment is manufactured. Revenue is recognized. Then the installed base can support years of service revenue. Each step can strengthen the economics, but each step takes time and execution. So the backlog is not the final proof. It is the starting inventory of future opportunity. The next decision shift is simple. The investor question should move from how large is the backlog to how quickly can the highest quality backlog become revenue, margin, and recurring service cash flow. That is a much more useful test than reacting to the headline number alone. The strongest bull evidence in this report was not the stock reaction, and it was not even the order growth. It was cash. GE Vernova generated $5.5 billion of operating cash flow and $5.1 billion of free cash flow in the quarter. Management also raised full-year free cash flow guidance from $6.5 to $7.5 billion all the way to $11.5 to $12.5 billion. That is a major change in the financial profile. It shows that the power boom is already producing cash, not only distant commitments. But there is still one tension. Revenue guidance increased by $1 billion, while the NEBITDA margin range remained unchanged at 12 to 14%. Higher revenue at the same margin range still creates more absolute NEBITDA. That is positive. The market, however, appears to want proof that incremental demand can also lift the margin rate, especially while a company expands gas turbine output. Management plans to raise annual gas turbine production from 20 gigawatts in the third quarter of 2026 to 24 gigawatts in 2028 and eventually 30 gigawatts in 2030. That expansion can create significant value if demand remains firm and pricing stays disciplined. It can also reduce returns if capacity arrives faster than profitable orders convert. This creates the third decision shift. The thesis is no longer only about finding demand. Demand has been demonstrated. The thesis is now about converting demand while protecting pricing, underwriting discipline, and returns on new capacity. The fair bull case is stronger than the post-earnings decline suggests. Data center-related orders exceeded $5 billion in the first half, more than double the total for all of 2025. The company is not relying on one product. It sells generation equipment, grid systems, and long-duration services across the entire electricity value chain. The backlog also contains both equipment and services. That matters because service revenue can extend the economic life of each installed turbine far beyond the initial sale. And management says the growing backlog carries healthy margins, supported by favorable pricing and disciplined underwriting. If those claims continue to appear in reported margins and cash flow, this quarter may look like a temporary expectations miss inside a much larger operating improvement. The bear case is not that demand is imaginary. The bear case is that the stock may require almost flawless conversion from here. Here is the decision framework. The own case remains intact when three conditions hold. Power and Electrification continue producing double-digit organic growth. Consolidated EBITDA margin moves through the 12 to 14% full-year range, and wind losses begin to narrow rather than consume more of the improvement. The watch case applies when orders and backlog keep rising, but margin guidance stops moving and capacity spending grows faster than evidence of conversion. In that scenario, the business can remain excellent while the stock becomes more sensitive to any execution miss. The pass case becomes more credible if one of three things happens. The company misses its target of 125 gigawatts under contract by year-end. Free cash flow guidance is reduced after this large increase, or Power and Electrification growth slows before wind reaches a more stable loss profile. Within this framework, the evidence supports a watch classification for a new buyer. The quarter was not weak, but it raised the evidence threshold. For an existing long-term holder, the operating thesis still looks intact. The next reports must prove that backlog growth is becoming durable margin, not merely more production commitments. The most important number is therefore no longer 88% order growth. It is the margin and cash produced as that backlog converts. GE Vernova is one company inside a much larger electricity bottleneck. The related analysis on screen maps where value may accrue across generation, grid equipment, and data center cooling. That broader capital chain is the next step in judging whether the AI power boom is creating durable shareholder returns.